Thank you. This is on? You guys can hear me? Good.
Yeah.
I promised Stephen I'd prepare a talk for him for this spectacularly successful event very, very early, and I did that without really knowing what I was going to talk about, because when you're working day in, day out with the global financial crisis, who knew where we would be by this time of the year? And then I was handed a wonderful, wonderful quote to start this talk off, which was that very, very recently, a leading public figure in Australia, speaking rather dismissively, said, "Oh, the global financial crisis, you mean the Northern Hemisphere recession?" Now, to my way of thinking, that's a bit like calling the First World War the Flanders fracas. Rather like World War I, the global financial crisis has far more wide-reaching consequences than the simple geographic location of its battlefields. Unlike World War I, unfortunately, the global financial crisis is not yet history. This talk is going to explain, in 16.5 minutes, how Australian banks are exposed to the ongoing and continuing to unfold global financial crisis. And like all good talks, it's going to start close to home. We've had a speaker earlier ask for a show of hands for university graduates. Can I get a show of hands, please, for people with a mortgage? Excellent. So this will be personally relevant to at least 2/3 of the room. Mortgages were an asset class overseas that were intimately associated with the global financial crisis. They're a reason why the Australian financial system looks superficially the same as many other financial systems. They're a reason why the Australian financial system has in fact behaved very, very differently to the financial systems in many other countries. And to explain that, I need to take you on a bit of a journey. Now, we all know where babies come from. I'm assuming everyone in this room does. Do we all know where a mortgage comes from? So, just very quickly, some statistics. The Australian mortgage sector today, from the perspective of a bank, is about $1 trillion. It's a good word, trillion. There's $1 trillion lent out for people to buy homes in Australia with. 60%, give or take, of all money lent into the Australian economy is lent for a residential mortgage. And that money comes from a bunch of different places. I'm sure there'll be a much smaller show of hands. Those people currently saving to buy a home? Excellent. So your money appears on this chart down here in consumer customers. And you make up, give or take, 25% of the funding that is on lent into the Australian mortgage market. Your business colleagues with surplus cash make up another 25%. And there's a third quarter of the money that is on lent into the Australian mortgage market that comes through what banks call wholesale funding, which means we go through a process of issuing debt into the global financial market and finding an investor willing to buy that debt. The biggest domestic investors in bank wholesale debt are superannuation funds. So if you like, your retirement money is also being reinvested in your home loan. The final quarter of the money comes from overseas. A quarter of $1 trillion is $250 billion. That is enough to make the big Australian banks very, very big players indeed in global financial markets. Now, if I were to show you this picture for France, if I were to show you this picture for Germany, if I were to show you this picture for Canada, the numbers down the bottom would all look a little bit different. What you'd find typically in other advanced countries is that the balance between customer deposits and domestic wholesale funding would move around a little bit. You would also find that in some of those countries at least, deposits exceeded lending and that the need for wholesale funding in other countries was diminished. What you would find if you looked particularly at the United States, however, is that there is a fifth box. And that fifth box would have been labelled in the United States securitisation. What that means is the financial engineering that allows for the credit risk associated with mortgages to be transferred from the banks who originate those loans, who work with their customers to advance the money, and the end holder of the credit risk. Now, every Australian bank has securitised a home loan, but the mass securitisation of home loans is not a feature of the Australian market. Once upon a time, in the heady days of 2005 and 2006, trying to borrow $250 billion was comparatively easy. Australian banks were simply among a crowd of large financial institutions participating in the global markets. We could borrow as much money as we wanted because the world was awash with cash, and we didn't have to pay very much to do so. But despite understanding, and this is an important point in the context of the global financial crisis, when it started, it was described as a credit event. And everyone associated with the financial sector, bankers, regulators, politicians, analysts, investors, understood that in banking, every so often, what you thought was going to happen, how likely you thought your customers were to pay you back, was going to be proven to be wrong. You were going to be caught out somewhere. You never knew where in advance, but sooner or later something bad would happen to you. It happened in Australian commercial property in the early 1990s. It happened in IT firms in the late 1990s. It happened to Enron and Parmalat and other large corporates in the early noughties. Thinking about this, appreciating the idea that credit had a cycle, was absolutely ingrained in the thinking of participants in the market. But somewhere along the way, the global financial crisis stopped being a credit event and started being a liquidity event. Banks that relied on borrowing, here and elsewhere, found it harder and harder to find investors willing to lend to them. Now, this is relevant to me personally. 10 years ago, I invented a method for measuring liquidity risk, the risk associated with a bank's funding strategy, which was pretty much the first anywhere else in the world. And I used to go around the world to conferences telling people what a great model this was. And it was tremendously useful from 2001 until 2007. And then it broke. And pretty much every single assumption in that model turned out to not work. The financial market, an assumption that had been built into the model, that there was a history that every year there would be more things to buy and sell, there would be more people doing the buying and selling, was just found to be entirely wrong. And market participants found life getting very, very complicated. And then, in September 2008, the music completely stopped. The US investment bank Lehman Brothers collapsed and was not bailed out. Now, earlier today, we had a discussion about Flowerdale, which made reference to the Christchurch earthquake. Imagine the way Australians reacted to the Christchurch earthquake. It was kind of small, it was in New Zealand, weren't terribly many people getting hurt. If you like, in August 2008, that's pretty much the description of the global financial market and its reaction to Northern Rock. The collapse of Lehman Brothers, for an Australian audience, could best be described as the disappearance from the map of South Australia. Absolutely and completely. Everyone in it, everything it produces, gone forever. No more red wine. No more Adelaide crows. No easy way to get from Perth to Melbourne or Sydney. That's what Lehman Brothers meant when it fell over. Within a month, the foundations of the financial market had been shaken so comprehensively that governments around the world, including the Australian government, successfully applied the financial equivalent of a defibrillator to get the whole thing restarted. Evidence of the defibrillation being behind me. The crisis is, however, still unfolding. So far, in 2010, there have been more than 130 bank failures in the United States. The biggest of the American banks are all shrinking their balance sheets. In Europe, banks that used to lend to each other to distribute liquidity across the European economy have changed fundamentally the way they borrow and lend. They are relying on their central banks, that is to say, they are relying on government to manage that process, borrowing and lending far more from central banks than from each other. In the global financial market, also, courtesy of the government bailouts, there is considerably more sovereign debt and considerably less bank and corporate debt. Everyone, governments, banks, central banks, regulators, rating agencies, have looked at the crisis and said simply, never again. The size of the fix, though, is such that even with a regulatory agenda moving at warp speed, the implementation plans are already stretching out to the end of this decade. We don't particularly want to go any faster than that, because the other thing we all know is that it's all too easy to sow the seeds of the next crisis in the solution to the current one. The global financial crisis is unprecedented. Nothing like it had been observed before, and it is revolutionary. It is very difficult from where we are today to actually imagine what will happen by the time it's really over. Now, interestingly, I've used this slide in a few presentations, most recently to a set of university graduates. My place of employment, I had to explain who these bands were. So if there's anyone here under the age of 25, the Knack were the biggest band in the world in 1979. And I think the greatest one-hit wonder ever. The guys on my left, on your right, they're the Rolling Stones, and they have been famous for an ever and ever and ever. You can use these to explain Australian banking, oddly enough. At the peak of the global financial crisis, Commonwealth Bank and Westpac were both ranked among the 10 most valuable banks in the world. We had our My Sharona moment. And to put that in perspective, our value on the Australian stock market exceeded the combined value of Citibank, or Citigroup, and Barclays, which is the largest bank in the United Kingdom. Each of us were worth more than the two of those put together. From the debt perspective, from the perspective of borrowing money in international markets, we are, however, much more like the Rolling Stones. All the Australian banks rank very highly on any list of bank borrowers, with Westpac and Commonwealth Bank being in the top 10 borrowers around the world, even though when you rank us by assets, by lending, we're somewhere towards the bottom of the top 50. And to continue to support home ownership aspirations, we're going to have the staying power that the Rolling Stones have shown so well. And to do that, we will need to watch out for ninjas. For those who don't know the acronym, the ninja is an American home loan. It's an American home loan you hand out to someone with no income, job or assets. You hand this out, you allow people to borrow for a home when they're a ninja because you believe that home prices will always, always go up. And that's a nice belief to have. But we had a skeptics talk earlier. There's something about positive conditioning. In order for our Australian banks to keep lending, in order for our Australian banks to keep borrowing, in other words, to keep persuading investors to invest in this country, they will need to preserve the quality of their mortgage portfolio. And fortunately, we can. This is a praying mantis trying to look a whole lot like a leaf. Australian mortgages really are leaves. Australian mortgages have been less risky, are less risky, and are highly likely to remain less risky than mortgages in many other countries around the world. And that's got as much to do with the legal structure and the tax structure in this country as it does to do with bank practice. Half Australian customers are ahead on their mortgage payments. In the United States, interest payments on your primary home loan is tax deductible. So there's less incentive to get ahead, and fewer people do. Mortgage lending in Australia is full recourse. When you take out a mortgage from an Australian financial institution, the institution has a right to pursue you for the repayment of that debt. So if your house price falls in value, you're still liable for the entirety of the debt. This makes it harder for people to walk away from their mortgages when home prices fall. It is not universal practice in other countries. Highly leveraged properties in Australia, properties where banks advance more than 80% of the value of the home, are covered through insurance, which acts as a further point of safety. Finally, Australia is not now, has not been in the short term, and appears unlikely to be in the medium term, subject to an oversupply of houses. We have all seen, no doubt, the boarded up houses in the United States, the boarded up suburbs in the United States. And there are similar stories in Europe. I heard it was overseas earlier this year at a conference on the global financial crisis, oddly enough. And there were rumours that in Spain right now, there are 1 million empty homes. Now, if you equate that to Australia for basic population, that essentially means that Canberra would be empty. That is kind of difficult to imagine in this particular country, where population growth exceeds dwelling growth, has exceeded dwelling growth, and appears to be continuing to exceed dwelling growth. So to sum up, the Australian financial sector is intimately connected to global markets through its reliance on offshore funding. Looks superficially very similar to failed financial systems in other developed countries, but is in fact very, very different beneath the surface. It has so far successfully navigated the first years of the crisis and currently has a reputation that is the envy of many. Now, that's not just the reputation of the banks. The Australian bank regulator is at the moment riding high as the best regarded bank regulator on the face of the planet. We are, however, in the middle of tremendous change, a change that affects all of us because we are all participants in the financial sector, and the banks and regulators and government are responding by playing to their strengths, just like the Rolling Stones. And that's an idea worth spreading. Thank you.